My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject International Financial Management as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 2 first important short question is: what is balance of payments, BOP? Balance of payments, BOP, is a record of all financial transactions made between a country and the rest of the world during a specific time, usually 1 year. It shows how much money is coming in, inflows, and going out, outflows, of the country. BOP includes exports, imports, foreign investments, loans, tourism income, remittances, etc. It helps the government understand the country's financial position in global trade. Main parts of BOP. 1. Current account deals with trade in goods, services, income and transfers. 2. Capital account records loans, investments and assets. Example: if India exports software worth 1,000 crore rupees to the US, that is an inflow, positive for BOP. If India imports oil worth 800 crore rupees, that is an outflow. Easy tip to remember. BOP is equal to India's international money diary. It records everything India earns and spends globally. Balanced BOP is equal to inflows is equal to outflows. Deficit is equal to more outflows. Surplus is equal to more inflows. Next important short question is: 2. Fundamentals of BOP. Fundamentals of BOP refer to the basic structure and working of the balance of payments. It tells us how a country earns and spends money globally. BOP is always prepared for a specific time period, usually 1 year. Main fundamentals. 1. Double entry system. Every transaction is recorded twice, once as a credit, inflow, and once as a debit, outflow. 2. To main accounts. Current account records trade in goods, exports, imports, services, income and transfers. Capital account records foreign investments, loans and assets. 3. Balanced BOP concept. In theory, total inflows is equal to total outflows. But in real life, countries may have surplus or deficit. Example: if India receives $100 million from NRI remittances, it is recorded as a credit in the current account. If India invests $50 million in the US, it's a debit in the capital account. Easy tip. Think of BOP as India's global money report card. Next important short question is: 3. Gold standard. Gold standard is an old international monetary system where the value of a country's currency was directly linked to a fixed amount of gold. Countries agreed to exchange their paper money for a specific quantity of gold. This system was used mostly during the 19th and early 20th centuries. How it worked? Each country fixed the value of its currency in terms of gold. Example: if 100 rupees is equal to 1 gram of gold, the government would keep enough gold to support that value. Countries could exchange currencies based on gold value, making trade easier and more stable. Example: if Britain set 1 pound is equal to 1 gram of gold and India set 100 rupees is equal to 1 gram of gold, then 1 pound is equal to 100 rupees. No confusion in exchange rates. Why it ended? Countries couldn't keep enough gold during wars or crises. The system collapsed during the Great Depression and World Wars. Easy tip. Gold standard is equal to currency backed by gold is equal to stable but limited. Next important short question is: 4. What is the Bretton Woods system? The Bretton Woods system was a global financial system set up in 1944 after World War II by 44 countries, including India. The goal was to create stable exchange rates and promote world trade and economic recovery. Main features: countries fixed their currencies to the US dollar. The US dollar was linked to gold. $35 is equal to 1 ounce of gold. Other countries could convert their currencies to dollars and then into gold. Example: if India fixed 1 rupee is equal to 10 cents and $1 is equal to fixed gold rate, then India could maintain currency stability by linking the rupee to the dollar. Institutions created: IMF, International Monetary Fund, World Bank. These institutions were started to support this system. Why it failed? By 1971, the US couldn't supply enough gold for dollars. So, the system collapsed and floating exchange rates began. Easy tip: Bretton Woods is equal to dollar at the center, gold in the background, and world currencies fixed to it. Next important short question is: 5. The flexible exchange rate regime. A flexible exchange rate regime, also called floating exchange rate, is a system where the value of a currency is decided by the market based on supply and demand in the foreign exchange market. There is no fixed rate set by the government or central bank. The currency value keeps changing daily depending on economic factors. Key features: currency rates are flexible and move freely. Central banks do not fix the rate but may interfere to reduce extreme changes. It reflects a country's economic strength. Example: if many people want to buy Indian goods, the demand for the rupee increases and its value rises. If demand falls, the rupee weakens. India follows a managed float system, where the Reserve Bank of India, RBI, watches and controls extreme movements. Easy tip: flexible rate is equal to currency behaves like stock price, goes up and down daily. Market decides the value, not the government. Next unit 2. Long questions. First important long question is: accounting components of BOP. Meaning: the balance of payments, BOP, is a detailed financial record of all transactions a country makes with the rest of the world. It shows how much money comes in, credit, and how much goes out, debit, during a specific time, usually a year. BOP has two main accounting components: the current account and the capital account. Some also include the financial account separately. 1. Current account. It deals with day-to-day transactions and includes goods, exports, credit, imports, debit, services, software exports, tourism, transport, etc. Income, earnings from foreign investments or payments made abroad. Current transfers, one-way transfers like gifts, remittances, donations. Example: an Indian working in Dubai sending money to his family in Hyderabad is a credit item in the current account. 2. Capital account. It includes transactions that affect a country's assets and liabilities with the rest of the world. Foreign direct investment, FDI. Loans taken from or given to foreign countries. Buying or selling foreign properties or shares. Example: if an Indian company buys land in the UK, it is recorded as a debit in the capital account. 3. Financial account, sometimes shown as part of capital account. Includes foreign exchange reserves, changes in assets held by central banks, purchase sale of bonds, etc. Example: if RBI buys US dollars, it's recorded in the financial account. Important rule: double entry system. Every transaction is recorded twice, once as credit, inflow, and once as debit, outflow, just like in accounting. Easy tip to remember. Current is equal to daily trade plus services. Capital is equal to big investments plus loans. Financial is equal to bank assets plus reserves. Think of BOP like India's international money balance sheet. It helps us understand how healthy our global financial position is. Next important long question is: 2 factors affecting international trade flows. Meaning, international trade flows refer to the movement of goods, services, and money between countries. These flows can go up or down depending on several factors. Understanding these factors helps us know why exports or imports increase or decrease. Main factors affecting international trade flows. 1. Cost of production. If goods are cheaper to produce in one country, they export more. Example, India exports software services because labor cost is low and skilled. 2. Exchange rates. If the rupee is weaker against the dollar, Indian exports become cheaper for foreigners. Example, a falling rupee helps Indian exporters but makes imports costlier. 3. Inflation rates. Higher inflation in a country makes its goods more expensive. Example, if India has high inflation, Indian products may become costly in global markets. 4. Trade policies and tariffs. Taxes on imports, called tariffs, or government restrictions, can reduce trade. Example, if the USA increases import duty on Indian textiles, exports may drop. 5. Income levels of countries. If income rises in a country, people buy more imported goods. Example, if Indian middle class income increases, we import more iPhones and foreign cars. 6. Political stability and laws. Stable countries attract more trade and investment. Example, foreign companies prefer to trade with India due to its stable democracy. 7. Logistics and infrastructure. Good transport, ports, and shipping facilities help increase trade. Example, better roads and airports boost India's exports. Easy trick to remember: pictile. P. Production cost. I. Inflation. C. Currency exchange. T. Trade policy. I. Income level. L. Laws and politics. E. Export infrastructure. Conclusion. International trade is influenced by both internal and external factors. By managing these smartly, India can increase its global trade and strengthen its economy. Next important long question is: 3 Indian BOP trends. 1. Current account performance. Q4 FY 2024-25 saw a $13.5 billion surplus, 1.3% of GDP, boosted by strong services exports, $53 billion, and high remittances, $33.9 billion, money hop, Reuters. Full FY 2024-25 recorded a CAD of $23.3 billion, 0.6% of GDP, showing improvement from $26 billion the previous year, Reuters. 2. Merchandise trade deficit. India's imports remain higher than exports, leading to consistent deficits, around $60-80 billion annually, n.wikipedia.org. June 2025 deficit dropped to $18.8 billion due to lower oil and gold imports, though exports slowed, ACU. 3. Services and remittances. Services exports, IT, BPO, continue to lead, offsetting goods trade shortfalls. Strong remittances provide vital stability to the BOP, ACU. 4. Capital and financial flows. Foreign investment flows remain uncertain, modest FDI but volatile equity inflows outflows. RBI's forex reserves, $653, 654 BN, help manage currency volatility, ACU. 5. Outlook and challenges. BOP is more balanced now thanks to strong invisibles, services and remittances. Trade deficits persist, and capital flow volatility remains a concern. With controlled CAD, less than 1% GDP, and large reserves, current risks are moderate, ACU. Summary for memory. Surplus in services and remittances. Narrower trade deficit in Q1 2025. Moderate CAD, -0.6% GDP. Stable reserves, $653 BN. Capital inflows volatile. India's BOP shows resilience through strong service exports and remittances, but dependence on imports and capital flow swings need careful management. Think of it as invisible strength versus visible weakness. Next important long question is 4. International Monetary System Evolution. Meaning, the international monetary system is a set of rules, institutions, and agreements that help countries manage their currencies, trade, and payments with each other. Over time, this system has evolved in different phases to meet global financial needs. Evolution of the international monetary system. 1. Gold standard, 1870 to 1930. Countries fixed their currencies to a specific amount of gold. Stable exchange rates, but countries needed to hold large gold reserves. Example, 100 rupees is equal to fixed amount of gold, same for other countries. 2. Interwar period, 1930 to 1944. Gold standard collapsed due to world wars and Great Depression. Countries started competitive devaluations, creating trade imbalances. 3. Bretton Woods system, 1944 to 1971. Set up after WWII by 44 countries. Currencies were linked to the US dollar, and the dollar was linked to gold. Created IMF and World Bank to support global financial stability. Example, was fixed to dollar, dollar was fixed to gold. 4. Flexible, floating, exchange rate system, 1971-present. Bretton Woods ended when the US stopped converting dollars into gold. Now, currency values are mostly determined by market forces, demand and supply. Countries like India follow managed floating, where RBI monitors the exchange rate. Example, if demand for Indian exports increases, the rupee becomes stronger. 5. Recent developments. Formation of EMU, Economic and Monetary Union. Countries like France, Germany, and Italy use a common currency, the euro. Use of digital currency, cryptocurrency, and blockchain is increasing globally. Easy tip to remember: GBFM. G. Gold standard. I. Interwar period. B. Bretton Woods. F. Flexible rate. M. Modern, euro, digital money. Conclusion. The international monetary system has moved from gold-based to dollar-based to flexible currency systems. Today, it is dynamic, technology-driven, and aims to support fair global trade. Next important long question is 5. The Economic and Monetary Union, EMU, and developments. Meaning of EMU. The Economic and Monetary Union, EMU, is a group of countries in Europe that have agreed to coordinate their economic and financial policies and use a single currency, the euro. It is a major step towards economic integration in Europe. Key features of EMU. 1. Single currency, euro. Most EMU countries use the euro instead of their national currencies. Example, France, Germany, Italy, Spain all use the euro. 2. European Central Bank, ECB. Like India has the RBI, the EMU has the ECB to manage the euro, set interest rates, and control inflation. 3. Common monetary policy. All EMU countries follow the same rules for interest rates, inflation control, and currency value. 4. Economic coordination. Member countries work together on budget policies, government spending, and economic growth strategies. Phases of EMU development. 1. 1991 Maastricht Treaty. Agreement signed by European countries to start economic and monetary integration. 2. 1999 Euro introduced digitally. Euro used for bank transactions and accounting. 3. 2002 Euro coins and notes. Physical currency introduced, countries started using euro in daily life. Example. Before the euro, Germany used the Deutsche Mark and France used the franc. Now, both use the euro, making trade and travel between them easier and more efficient. Easy tip to remember: EMU is equal to euro makes unity. E. Euro currency. M. Monetary policy, common. U. United European economies. Recent developments. Some EU countries like Sweden and Denmark still use their own currencies. The Eurozone faces challenges like debt crisis in some countries, example, Greece, but it remains strong. The EMU is exploring digital euro to match modern trends like cryptocurrency. Conclusion. The EMU is a strong example of countries working together economically. It helps in reducing currency risk, boosting trade, and promoting unity across Europe.